Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Mark Phillips, CEO of Harvest State Financial, for our monthly review of volatility trends, of course, heading into options expiration Friday. Mark, it's great to see you as always. And let's review volatility trends from October expiration, from the election and positive vaccination news to where we are right now heading into November expiration.
Absolutely. Well, I think you hit the nail on the head there with those two big factors, right? Whether it's the election or whether it's the vaccine news, we're seeing a lot of factors that are overall deflating the volatility in this environment. One benchmark that we tend to use to track this is where the 30-day out implied volatility is trending. And, in the QQQ ETF that tracks the Nasdaq 100, going into the election, that was trading as high as around 38 implied vol. We're all the way down in the very low 20s right now. So a reading of around 21, 22 right now. So we've seen a ton of deflation of this volatility. While not all of these election and pandemic issues have been totally resolved, the market is really moving into not quite a low vol environment, but we're much closer to the sort of the lower end of what we'd consider, a high vol environment. To kind of put that in perspective, January and February of this year, we were seeing readings in the low teens of like only a 13 implied vol 30 days out. So not quite all the way down there, but we have seen a huge deflation in the overall volatility environment with news on both of those fronts.
So even though we've received positive vaccination news, we have the physical election out of the way. What is the volatility market suggesting for the remainder of the year? Because we still have to work through COVID-19 and the potential impact to the economy.
Certainly. So looking towards the end of the year, a lot of practitioners and market participants are really trying to guess where the market goes. It's a curious situation that we do have these two major questions, yet the market is very close to all-time highs. So there are actually two interesting market structure things that I think are going to have an impact from the volatility markets on the ultimate underlying equity markets. And the first here that's not necessarily novel, but sort of interesting to think about is just the calendar. Simply looking at the calendar going into the end of the year between holidays like Thanksgiving, the Christmas holiday, and the New Year's holiday, those are all days out of the trading day. We also see, or I should say, those are trading days where the market's closed during the upcoming expiration cycles. In addition, people tend to take vacation. There's sort of a self-reinforcing cycle where low volatility begets low volatility. So I expect to see volatility continue to trend downward towards the end of the year. And then one of the effects that this is going to have, I think, is looking at the implied volatility coming in. That actually might create an effect where we start to push a little bit of this Santa Claus rally that they like to call into the end of the year. And this has to do a lot with how dealers are positioned. So typically the market makers, the liquidity providers in this option space tend to be long calls and short puts. And so that's because customers like to sell calls as an overwrite strategy, and they like to buy puts as an insurance strategy. So both of these positions require the dealers to hedge with short deltas. So they're selling stock against these positions. As the volatility environment comes in, the deltas of those options are going to also come in. So if you think about the delta as sort of the implied probability of the market moving over that level, over that strike level, as volatility comes in, those probabilities are going to come down. We're going to expect a lot less movement. So as those deltas come down, we're going to see the dealers ending up buying a lot of stock to re-hedge their position. So there is going to be an effect where we could see in this decreasing volatility environment, dealer VANA flow that is going to push the market back up. So, those are two trends we're really keeping a close eye on here, is how that volatility coming in is going to, affect the underlying markets going into the end of the year.
Yeah, that's a great point that you bring up, Mark. Thanks for addressing that. And let me ask you another question. When we talk about options expiration, regardless of what month we're talking about, does the action take place on Friday, or is it positioning largely done prior to that, like on Wednesday, for example?
It's a really interesting question. And I think this is one of the fun quirks about options is that, while we talk about them in terms of volatility and we talk about the theoretical movement of what does a 35 vol mean or what does a 23 vol mean, that ultimately for traders and investors that owns positions, the path that takes to get to that 35 volatility is really going to matter. So sometimes expiration means everything. And sometimes it's, you're waiting to the very end of the wire to get out of a position. But other times, if the stock took the right path early on in your trade, you might have easily closed that out. We often hear studies around the 70, 80%, take profit level. So if a strategy moved in an investor's favor early on, expiration might be a total non-event for them. Then there are others that are completely waiting down to the very wire in that very last minute of 4 o'clock Eastern on Friday to really get into their positions. November being one of the main serial expirations, that tends to also have a high concentration of positions. So I know we have all these weekly options out there and midweek options, but the month expirations tend to have the highest open interest and bring the most action coming into expiration.
So as always, it comes down to staying with your trading plan. Great advice as always. Now, Mark, Harvested Financial offers strategy execution as a service, whether it's for model portfolios or custom strategies. How are these strategies impacted by options expiration? Do you have to continuously adjust for expiration?
Yeah, expiration's a big management question for any investor. And so part of that strategy execution is managing the expiration rolling cycle, whether it's, repositioning for a further month out or closing down the existing position. Expiration definitely is a busy time for us. Some of those strategies where you might be short volatility, especially on a shorter term trade, you really have to wait until the very end and that very last minute of trading for all of that value to really deflate out of the options. So on the short side, you're really waiting until the very end to close and get out of that position, squeezing every last penny that you can out of there. But on the long side, you also see a lot of action because even if you're long call spread or a put spread or some type of option structure, you might want to close that out if it's in the money because of the cost of going through the expiration cycle. So you do see a lot of retail activity, and we're performing a lot of trades on our clients' behalf to do exactly this, to close out of those positions and make sure that they don't go through the expiration cycle. You might have a partial in the money call spread that needs to be closed out. So there's a lot of action, especially if your positioning is putting you right around the strikes where that's pinning. And the options pricing model isn't necessarily working in our favor here because of the way theta decays out of the options price. That really happens in a non-linear fashion. So it drips, and then it really all comes out at the end. So I'm not kidding when I say it's those last minutes of expiration Friday that can be really critical and unwinding and getting out of positions that you might have on.
So give us an example of a curated strategy.
Sure. So, I mentioned that one of the things that we're looking towards going into the end of the year is a continued compression of the volatility and a continued drop in the overall implied volatility environments, and leaning a little bit bullish because of that. So one of the strategies that we've been looking at a lot recently is a sort of form of a broken wing butterfly. The options experts will look at that and say that's a broken wing butterfly. We've punned it a little bit differently here because I don't like to call our strategies broken. So we call it the modifly. But essentially what we're doing is we're selling near out of the money puts to buy slightly closer to the money puts, and then really protect ourselves all the way on the downside with another put. We collect income in this strategy, so it acts as sort of a yield enhancing strategy where if the market continues to rise, we'll keep our premium that we have. We're protected against a near downside move here, and that's actually our max profit opportunity if the market drifts down slightly here. Because we are short volatility, nothing comes without risk, so the risk in the strategy is to the far downside. But one of the reasons we really like this trade and this trade structure overall is that it presents a number of different opportunities to get in and out of the position over time, depending on some of those paths that I mentioned before, that to the extent that we see a sharp drop, there are opportunities to hedge out in that higher implied volatility environment. Or potentially, if the trade does go our way, there are ways to lock in profits over time. So it's not always just about putting on a trade and expecting it to land here by expiration, but we like to set up structures that give us a couple different outs throughout the course of the strategy and really manage that depending on how the trade plays out over time.
And to wrap up here, are these types of strategies for institutional investors, or can advisors use it for their client portfolios and other retail traders?
Absolutely. We really like to believe that derivatives are for everyone here, and that this is the type of strategy that can be executed in very small accounts also. Some of the potential bigger risks obviously won't be able to be taken with the smaller accounts, but really this structure can be done at any strike level, any strike distance. And in a lot of these liquid products, we have that kind of granularity. If you're looking at some of the top tier ETFs with dollar strikes everywhere, retail accounts can really put on exactly the amount of risk that they're looking for. But both advisors And institutional clients really like this structure also. It provides some of that yield that they're looking for. It does provide a positive carry type strategy that diversifies away from some of the other traditional equity linked portfolios. So in many ways, all of those investor classes are looking for the same things. It really just comes down to how they access them. And at Harvested, what we're looking to do is provide exposure to this type of traditionally institutional strategy for advisors and retail clients.
All right, Mark, great to catch up with you as always. We look forward to speaking with you in December. Thanks for joining us on Trade Talks.
Thanks, Jill.
You got it. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.